10 mistakes to avoid when investing in the stock market. Investing in the stock market involves high risk and volatility, but it can also lead to very high returns. However, if you are not careful with your investment strategy, then you may end up losing more than you could have gained. In this video, we will discuss some reasons why people invest in stocks, as well as some common mistakes that can be made when it comes to stock investing. Welcome to Stocks Galore, the place for those in passionate pursuit of financial freedom. Smash the like button now, subscribe to our channel, and click the notification bell to be notified when new videos are released. Why investors make these mistakes? A lot of investors make these mistakes because they are too focused on the numbers and not enough focus on the fundamentals of a business. Most investors also make these mistakes because they are not aware of the general principles of investing and the importance of diversification. We will go over the 10 mistakes investors make when investing in the stock market. Make sure you watch the video till the end. I have some bonus key mistakes to avoid I'll share with you just for sticking it to the end. Here are the 10 mistakes that people make when investing in the stock market. 1. Not understanding how the stock market works. As a stock market investor, you need to actively monitor the market and not be afraid to make trade decisions. It is important for investors to understand exactly how the market works in order to make educated decisions. The stock market is a complex system that is hard to understand without some knowledge of the basics. The stock market revolves around buying and selling shares in companies while using investments to generate a profit. The more shares you have, the greater your purchasing power is on the company's stocks. The more shares you own, the more influence you have over a company's management decisions and products that they offer. Starting out with understanding how stocks work will help you make better decisions on where to invest your money. As much as you might want to believe that your investments will bring you the riches, if not for investing in the right way, then you could end up losing your entire fortune. The process of investing can be tricky and complicated, but it's worth understanding how to avoid the common mistakes that lead to loss of money. Managing money is an overwhelming task for most people. It has become increasingly difficult to make sound financial decisions because of the vast amount of information available to us. There are also plenty of financial terms that are foreign to the average person, making it difficult to understand what does and does not qualify as a risk. 2. Buying stocks at too high of a price. It's a simple idea that sounds great in theory, but the execution is the tough part. There are a few strategies to minimize the risks of this mistake. Buying high and selling low is a phrase that has become synonymous with investing. It means to buy at a higher price and sell at a lower price, which is basically taking a loss on your investment. This mistake can have negative consequences, so you should avoid it. Investing in stocks can be a risky decision, but it can also be a profitable one. Many traders make money by investing in companies that are expanding and have a bright future ahead of them. However, some investors take this risk too far and buy stocks at a price that is significantly higher than its value. This puts their investment into danger without giving them any chance to make money from it. A strategy for investing in stocks is to buy on the dip, or when the price is low. When buying on the dip, it is important to do your research and invest in an opportunity that has strong growth potential while still remaining relatively affordable. I made a separate video on this channel titled The Effective Guide on How to Buy the Dip in the Stock Market. It gives you a detailed insight on how to effectively buy the dip without catching a falling knife. You should watch it. 3. Selling your stocks early and often. This mistake is the one that happens the most often. Investors who sell their stocks early and often end up buying on the dip and getting burned. This is because they are unable to recognize when a stock recovers. It takes an experienced eye to do this. Selling your stocks too soon also creates a missed opportunity to make more money on subsequent buybacks. We don't want to make more money, but sometimes the best way to do so is not to sell your stock early, but hold on to it. This mistake is often made by the wrong type of investors. Many people rush into a trade without doing their homework and end up losing a lot of money. This mistake will only cost you a few $100s, but if you ask around, you might find that it could have cost you thousands or even millions of dollars. 4. Waiting too long before selling your investments. Buying an investment is one of the most important financial decisions you will ever make. However, many people end up buying into a company that fails to meet their expectations, which means they are left with a large loss on their hands. One way to avoid this is by selling your investments before they fail. Investment analysis is a process, and it can take time before you should sell your stocks. However, there are a few instances when waiting too long should be avoided. 5. Investing in companies that you don't understand or trust. Investing in companies that you don't understand or trust is a risky endeavor. There are many companies in the market today that have gone bankrupt, so investing your hard-earned money in them is quite risky. But there are also many online resources available to help investors pick out the best investments for their portfolios. Don't invest solely on the basis of what someone is telling you or what others are doing. Invest with an objective self-analysis and understanding of how long it will take for your investment to pay off. There are a number of misconceptions about investing that a lot of people fall into. This mistake is easily made because a lot of the information you read online is not true. To avoid misinformed investing, make sure to do your research before taking any investment decision. Investing can be a confusing process for many people. People often make mistakes out of ignorance when they're not fully informed with all the details of an investment opportunity. It's important to stay up to date on the latest trends, companies, and news in your industry. 6. Not diversifying your investment portfolio. The stock market is a volatile and unpredictable market, which means investing in a specific company could quickly become a risky decision. Instead of investing all your money into one stock, you should have a diversified portfolio of many different companies that can offer stability when the market changes. If you own too many stocks in one company, your portfolio will be over-concentrated, which could lead to losses. Investing is important for anyone looking to secure their financial future. However, with the current market conditions, it can be difficult to determine what are the best investments with which you should diversify your portfolio. Sometimes the best option is to simply use a low-cost index fund. We all know that it is important to diversify your investments. The more varied your portfolio, the more stable it becomes. Many people, however, tend to put all their eggs in one basket. They assume that investing in just one type of investment will be enough to secure their future and not diversify at all. This can lead to a financial downfall because the market can change unexpectedly and you may be wiped out. The problem with this approach is that it can cause investors to become overly confident in their pick and neglect other opportunities. As a result, they may lose out on opportunities that they might have taken advantage of if they were more diversified. In 2008, the financial crisis hit the world, and the entire economy was thrown into turmoil. The lack of diversification has made it harder to recover from this crisis. Investors are urged to rethink their investments and diversify their portfolio. It is important to diversify the investment portfolio in order to reduce risk. If you are not diversifying your investments, you are investing in one asset. So if that one asset takes a hit, your entire portfolio suffers. 7. Investing based on emotions and not on what the market is telling you. A mistake that many investors often make is to trade on emotion. In today's fast-paced world, investors are often caught up in the moment and the risk of losing money. It's important to think objectively and not fall into the trap of emotionally tying yourself to your investments. Investing should be a calculated decision. Most people know that emotions should not be used as an investing tool, but no one knows why. This is mainly because it is difficult to read the market properly because there are too many factors that could influence it. In order to find out what the market is telling you, it is important to look at the bigger picture and not just your emotions. Emotions drive our decisions, and we often make decisions based on what we feel, rather than what the market is telling us. When we watch a company we've invested in do well, it's all too tempting to fall in love with it and forget why we bought the stock in the first place. Always keep in mind that you bought this investment to profit. Consider selling the stock if any of the fundamentals that inspired you to invest in the company change. 8. Not buying when the market is low. Buying low and selling high is one of the most profitable investment strategies. However, in order to maximize your profits, you need to know when the market is low. Many people are aware of the market's ups and downs, but sometimes it's hard to know when the market is at its lowest point. Many investors make the mistake of waiting for the market to go up before buying, when in reality it is better to buy when prices are low. It is not always the best idea to buy stocks when they are at their lowest point. Buying stocks when they are cheap is a good strategy, but it's not always the best idea. The key to success is to buy stocks when they are grossly undervalued. 9. Hitting the panic button. Avoid thinking that you must act before others do when there is nothing you can do to affect the market in any way next week or next month. Anxiety is a natural feeling for people who have a strong sense of responsibility and a fear of failing. It is normal to feel anxious when you don't know what to do or how to handle the situation. Sometimes it is better for you to just take a step back and allow yourself some time before making any decision or taking any action. By doing so, you can improve your mental health and capabilities by allowing yourself time to sit with the problem and think things through. Before making an important investing decision or taking an action, it can be beneficial if you step back from the situation and allow yourself some time to think things through. 10. Investing in a company that's not profitable yet. When you invest in a company that is not profitable, there are many risks that come with it. When you invest in a company that is already profitable, however, your chances of making more profit are much higher. It's never a good idea to invest in a company that's not profitable yet. As an entrepreneur, it is your job to know what kind of business you are starting, how much money it will make this year, and its future potential. It's also important to be prepared for changes in the market and your company's product or service. Key takeaways: don't invest solely on the basis of what someone is telling you or what others are doing. Invest with an objective self-analysis and understanding of how long it will take for your investment to pay off. Avoid putting all your eggs in one basket. Diversify your portfolio to reduce potential risks and increase potential benefits. The worst mistake you could make is to invest without doing any research. Researching the industry and the companies you want to invest in will help ensure your investment goes as planned. Try not to invest too much of your money. It's better to spread your money across several different investments rather than putting all of it into one single company or stock. Bonus key mistakes to avoid: 1. Inability to be patient. Long-term gains will be higher if you increase your portfolio slowly and steadily. It's a recipe for disaster to expect a portfolio to accomplish something it wasn't built to do. This means you should keep your expectations for portfolio growth and returns modest in terms of time. 2. Expecting to get even. Getting even is just another strategy to ensure that any profit you've made is lost. It suggests you're holding off on selling a loser until it reaches its initial cost foundation. This is referred to as a cognitive error in behavioral finance. Investors lose in two ways when they fail to recognize a loss. To begin with, they avoid selling a loser, which may continue to depreciate until it is no longer worth anything. Second, there's the opportunity cost of putting those investment funds to greater use. 3. Trying to time the stock market. The stock market is a tool for investors to make a profit on their investments. However, many people think that they can time the market by investing when the market is low and selling when it's high. This is a bad idea because of two major reasons. The first reason is that the market has been around for over 400 years and has seen many ups and downs. The second reason is that stocks fluctuate wildly and can change in a matter of days. The stock market is unpredictable, especially at the beginning of a new year. It is best to not time the stock market because you would not know if it will go up or down once you try to time it. There's a popular saying in the market that goes, "Time the market beats timing the market." 4. Investing in assets that are not liquid or well established. Assets are defined as material possessions that are of value and can be easily traded in order to acquire something of equal or greater value in the future. They must also be in a form that is easily converted into cash. It is important that the investment opportunity has a solid track record and can be expected to generate returns that exceed the risk factor attached to the investment. Investing in assets that are not well established refers to investing in assets that have no track record and may not continue to generate value. This mistake is often made by people who are new to investing. Conclusion: mistakes are unavoidable in the investing process. Knowing what they are, when you're making them, and how to avoid them will aid your investment success. To avoid making the faults listed above, make a well-thought-out, systematic plan and stick to it. Set aside some fun money that you are fully prepared to lose if you must do something dangerous. The key to successful investing is patience and discipline. If you follow these principles, you'll be well on your way to constructing a portfolio that will reward you with many good returns over time. So there you have it. If you enjoyed this video, smash the like button now and subscribe to our channel to be notified when new videos are released.